Welcome back to our financial planning workshops. Today we're going to be talking about investing, first of two parts. I'm Fred Smith with the Silicon Valley chapter of the AAII, and you can download these slides if you wish at our local chapter website. And I've also given you my email address down here if you have any questions or comments. This is our standard disclaimer. Basically, it just says that the views expressed here are mine and not necessarily those of the AAII. These workshops cover a broad range of topics. And last month we talked about financial planning, the big picture, which covered the 5 pillars of financial planning, including investing, taxes, retirement planning, risk management or insurance, and estate planning. We'll be covering all of these topics in more detail in the coming months, all the way through to June. For today, our workshop is going to cover investing. We'll start off with the 5-step investing process. We look at the various asset class characteristics. We'll touch briefly on modern portfolio theory and show you how that works. And we'll look into building a simple multi-asset portfolios. Okay, let's start off with the 5-step investing process. Step number 1 is to define your personal investor profile, know thyself. Step number 2 is to document your investor policy statement. We'll cover these over the next few minutes. Then you design your personalized portfolio. Go online to implement the portfolio, and finally, for step 5, we'll explain how you want to rebalance it. Review it on a regular basis and rebalance if necessary. Okay, first, know thyself. Adam Smith, a long time ago in the 18th century, said, "If you don't know who you really are, the stock market is an expensive place to find out." I couldn't have said it better. So we start off with your PIP, the personal investor profile. That includes a number of elements. It's just personal data, how old you are, whether you're retired or not, your marital status, things like that. Your time horizon, are you looking to invest this account for short-term goals, or do you have any long-term goals in mind? And what's the purpose of the account? What's your risk tolerance? This is the classic eat well versus sleep well decision. You can get questionnaires to cover this, at any of the major financial houses like Schwab or Vanguard, Fidelity. Perhaps a better guide than the questionnaires would be to look at your own past history. What did you actually do if you were investing in 2000, 2001, 2002? We had a major crash at that point, and where the market dropped over 50%. What did you actually do then? What did you do in 2008 in one single year where we had a similar drop? So looking at what you actually did, if you were assuming that you were investing at those times, might just be a better guide than the questionnaires that are available. You need to document on your PIP what your income needs are. If you're retired, you're using this portfolio to generate the income that you need to live off. Or if you're younger, you're looking mostly for capital gains and you don't need the income. So on your PIP is a good place to document those items. The other item that should be on there is your tax status. What's your federal income tax bracket and your state income tax bracket? Are you using the alternative minimum tax or not? So all of this should go on it's really a short document. Could be as small as 1 page, but you should write it all down. And one of the reasons for writing it down is because it's there for your financial power of attorney if you ever become disabled. It gives them a guide as to what you're doing. We talked about risk on your PIP, so I wanted to briefly hit on a number of ways of controlling risk while we're here. I'm a big believer in diversification. So we start off with the diversification of the asset classes. And most of you are obviously very familiar with this already. You've got cash, you've got bonds and stocks. And very often these are also divided further into domestic and international. If you get a broad range of securities, covering different asset classes, that form of diversification gives you one good starting point for controlling risk. Something that people very often overlook is tax diversification. I believe in having accounts in 3 different tax status types. You can have a taxable account, a tax deferred account as in your traditional IRA, or a tax-free account as in a Roth IRA. So if you diversify across these, it gives you some protection going forward. You won't be a real hero in terms of having all of your assets in the right place, but since we don't know what the future tax world is going to look like, if you're diversified across these 3 different types of accounts, you won't be a real goat either. And we are obviously familiar with, or somewhat so, with time diversification. That normally includes dollar cost averaging, which some of you are familiar with, or value averaging, which you may not know about. I want to real quickly look at dollar cost averaging here for those who are not familiar with it. Supposing you've got $6,000 that you want to invest in the stock market, and you're a little nervous about putting it all in at one time. One way to do it would be to put $1,000 into the market each month for 6 months. And then as the share price varies up and down, you buy a different number of shares with your $1,000. And this column gives you the cumulative number of shares and the cumulative dollars. So it means at the end of 6 months, you invested your $6,000. The average price for share over the 6-month period is $10. And you've accumulated 611 shares. So if you work out the average cost, it's the $6,000 divided by the 611 shares. So you have paid an average cost of $9.83 for each share, which is a little better than the $10 average price. It's not guaranteed to work every time, but usually it's a way of getting into the market gradually if you're a little nervous about doing it all at once. Another way of doing a somewhat similar thing is called value averaging. In this case, you're again putting your $6,000 in roughly over a 6-month period, but instead of putting it in equal $1,000 increments, you're investing whatever amount it takes to bring the end value up to $1,000 at the end of the first month, $2,000 at the end of the second, then $3,000, $4,000, up to $6,000 at the end of the 6th month. So you're putting in, again, a different number of shares each month. And at the end of the 6-month period, doing it this way, you have invested a total of just over $5,000. And the average price per share is, again, the same $10 per share. And you've accumulated 545 shares. And this gives you an average cost per share of the $5,187 divided by 545 shares, or $9.52 per share. Again, a better cost than the average price of the per share over that time. Your personal investor profile should be a fairly stable document. You should not need to tweak it, very often. However, over the course of your life cycle, it will tend to change a little bit. And what I'm showing here might be the typical changes for a lot of people, but each individual may be different. Your time horizon, when you're in your early career, you're going to have a long time horizon, but that may gradually shorten a little bit. Certainly as you get into late retirement, you may be looking at a shorter time horizon. Your risk tolerance is high initially because you can afford to make an occasional mistake and you have the time to recover from it. But if you're in late retirement, your risk tolerance may be a lot lower because you do not have the ability, if you're no longer earning a regular salary, you do not have the ability to recover from mistakes. So if you're in high volatile, high risk portfolio, it could be a problem out here. Possibly, I mean, it depends. For some folks, that may not be the case because you may not necessarily need this account to live on. Your income needs may change. And initially, when you're in your early mid-career, you don't need the income. When you're earning a salary, but again, in retirement, you may need that income. Your tax status may change, from a low tax status through to high, and then may go low again in retirement. But this will be an individual thing. But the point I wanted to make was that over the course of your lifetime, your PIP may change, but it's not going to change. It may change every decade or so, but it's not going to change every few months or every year. Okay, let's look at step 2, your investment policy statement, or your IPS. This document outlines the general philosophy of how you want to manage your portfolio and what the goals of it are. And in this document, you want to set out the rules, the limitations for managing the portfolio. It should define the asset classes that you want to use, and they give you make the determination on how you want to have those asset classes distributed. What's the broad asset allocation you want to use? You should also make a decision on asset location. Which accounts do you want each asset in? Where do you want your fixed income assets? Where do you want the accounts that are heavy on equities? And we'll talk about that in a few minutes. If you want to make tactical changes to your portfolio, this would be the place to spell them out. If you do, as the market conditions change, some people like to tweak their portfolio or even make some significant changes. If you want to do that, you should spell out the conditions here under which you would want to make any trades. If you want to just stick with your strategic portfolio, then you should say so here. This would be the place to do that. You should say how and when you're going to do your rebalancing, under what conditions, and then you should spell out if there are any prohibitions. If you don't want people investing, if you don't want to invest in maybe any equities from South Africa, this would be the place to do it. Or if you don't want any derivatives in there, or if you don't want any alcohol or tobacco stocks or whatever, this would be a good place to spell all that out. So what you're doing here with your IPS, it may only be 1 or 2 pages. It doesn't have to be a huge document, but you should spell out generally why you're investing and how you intend to do it. And the document should be complete enough so that a third party could take your PIP and your IPS, and from those manage your portfolio for you if at any time you ever became disabled and were not able to do so. And just because you're not using a financial planner, you should do this for yourself, so that if and when the market crashes, instead of fretting in a panic mode of what to do and what you should do is go back and look at what you've said in your IPS, and where you've worked it out in a nice quiet moment, and look and see what you've written down and documented for yourself, and follow that rule rather than panic. Okay, one thought that comes to mind is that it's useful. Some people find it useful to look at your IPS and see if you can summarize it on an index card. Christine Benson Morningstar gives one example here. I have my own favorite of trying to summarize it in 10 words or less. That's obviously a gross synopsis, but if your IPS is simple enough, you should be able to summarize it very simply. You're not putting in all the details, of course, but for me personally, my 10-word summary would be: build a diversified portfolio of cheap index funds, rebalance annually. So I challenge any of you folks out there to go write your own 10-word summary after you've written your PIP and your IPS. Step number 3 is to design your actual portfolio. you need to research the asset classes that you've defined. And in your IPS, you've said which asset classes you want to use. You now need to look and see what funds are you going to use that cover those asset classes. You're going to use index funds. Are you going to use any of the alternative investments, real estate or commodities or anything like that? Why are you picking these? Are you looking for the lowest cost, or are you looking for the least tracking error, or so on? But this is where you start fleshing out all of the details. Then you pick the allocation in these asset classes to match the risk tolerance and the asset allocation that you have worked out on your IPS. And also look here at the asset location. Again, decide which funds belong in which accounts. I've said, I hit on this very quickly earlier. So the fixed income funds generally fit best into your tax-deferred retirement accounts, your traditional IRA, or your 401k, something like that. Risky high-growth funds could well belong in your Roth account. High growth, risk and return go together. So the high growth funds are likely to be the most risky, but your Roth account should generally be a long-term account anyway. So that's a good place to put the high growth funds, especially since after they have grown, hopefully in your Roth account, you will no longer have to pay any taxes on them when you're withdrawing from the Roth account. And any of the remaining funds can go into your regular taxable account at Schwab or Vanguard or wherever. Most people, pardon me, most people figure that if they have, let's just say that assume that they have decided to invest 30% in fixed income and 70% in equities and stocks, and that the 70% is scattered with 50% of it, 50% going into U.S. stocks and 20% into international stocks. Let's just assume that for a minute. What a lot of people do is set up that same 30, 50, 20 allocation in their traditional IRA, and their regular IRA, and the Roth IRA, and that would certainly work. It's one simple way of investing, in a diversified portfolio scattered across the three accounts. But it's not necessarily the optimum way. An alternative way of doing that is what some people allude to as a household portfolio, where you rebalance the whole portfolio, not each account separately. And to do that, you might put all of your fixed income assets into your traditional IRA, and all of the high growth stocks, maybe your small cap growth stocks, or your emerging markets, stuff like that, into the Roth IRA. The reason for doing this is because in the traditional IRA, you're going to be paying taxes when you withdraw the money from this at the ordinary income tax level anyway. So you may as well put the stuff into the traditional IRA that is going to be taxed highly regardless of where it is. So the fixed income fits best in your traditional IRA. On the other hand, if you put the high growth stocks into your Roth IRA, hopefully the high growth, even though they're high risk, should over the long haul grow, very significantly, and all of the appreciation on those will be tax free if you have them in the Roth IRA. And then in the regular account, you can put the balance of what you wanted to invest, and that's going to obviously be taxed, on an annual basis, or for any of the interest and dividends from it, and the capital gains when you trade them. You're not going to have a nice clean diagonal like this. You're not going to have absolutely 30%, 50% and 20% here. It's going to, in practice, there'll be something in these other boxes as well. But you should shoot to put the bulk of your allocations into each of these boxes as I've shown here, and have smaller amounts as necessary in these other boxes. And some portfolio managers argue that if you follow this strategy, you can gain as much as an extra 1% on your after-tax return. So it's worth considering. It's a little more work, but it's worth considering for some people. Step 4 for your of the investing steps is to actually implement the portfolio. This is the easiest part of it. You just go online, implement the trades that you figured out on the previous steps. You may find that you have different accounts at different financial institutions. All of your traditional IRAs and Roth could be at Vanguard, for example. But you might have a taxable account at Schwab. You might have a taxable account at Vanguard as well. Who knows? But they may well be at different accounts. And in practice, that can make it a little trickier when it comes to rebalancing. But you got to do what you got to do. And in general, the simpler you keep it, the easier it is to manage it. You also need to decide, are you going to execute all the trades immediately? You wake up on a Monday morning, you're all set to go to implement your portfolio. You set all of these up on online and hit the go button immediately, or are you going to elect a dollar cost average into it or value average? So those options are available. Step number 5 is the review and rebalance step. The important thing here is to follow whatever strategy you've defined in your IPS. For a passive portfolio, you can evaluate your portfolio on a calendar basis or on a threshold-driven basis. On a calendar basis, you're going to do it, maybe on your birthday every year, or do it, the 4th of July, whatever date you pick each year to do it. On a threshold basis, what you're really doing is looking at it more often, and if it's within certain guidelines, you don't touch it, and if it's outside a certain percentage of your strategic portfolio that you've defined, then you would rebalance it back to the initial value. For an active portfolio, you got to go to your IPS and see what you've spelled out there as to when you make a purchase, when you make a sale, under what conditions. And in general, you're going to be looking at your portfolio much more frequently, typically weekly, or some people even daily. And the other thing when you're reviewing your portfolio is to look and see, have you actually met the projected return that you set out in your IPS and the risk level? Is the portfolio actually performing in the way that you had defined that you had expected it to do? In practice, rebalancing your portfolio can be, I won't say it's tricky, but there's some hidden things that some folks don't think about. First of all, the reason for doing it is to reduce risk. You're not rebalancing the portfolio to try to gain a higher return, which is what some people think. And in fact, it may even put a slight damper on your return. But what you're trying to do is, the whole purpose of doing it is to control the risk. Usually it's most helpful to rebalance when it's most difficult, because what you're really doing is selling your winners and using the proceeds from that to buy more of your losers. In other words, sell high and buy low. It's the opposite of the feed the winners and starve the losers strategy. It can be periodic or calendar driven, where you do it every year, as I said, maybe on your birthday or some specific date, or it can be threshold driven, where you look at the thing more frequently, perhaps monthly or even quarterly, and decide if the allocation has strayed from your strategic value by more than a certain amount, say 10%, then you actually rebalance it. And any other times you just look at it and say, yeah, it looks okay, it's within the threshold, I don't need to do anything. Practical aspects of rebalancing. There are ways to do it, without having to necessarily sell stock from your winners to buy more of the losers, because the sale is in some cases going to trigger a tax event. One way of minimizing the number of sales is to use your monthly contribution, your contributions regardless of whether they're monthly or for a 401k or whatever. Well, a 401k, you're paying taxes at this time anyway. But if you can use your contributions to buy more of the stocks that are of the assets that are undervalued at, at that particular time. You can also use your withdrawals. If you're retired, your required minimum withdrawals to aid in rebalancing. You're going to have to, folks who are over, I think the RMDs start at age 72 now. You're going to have to start pulling money out, and you can as you're pulling money out of your retirement accounts, you can pull it from those funds that are overvalued, and it's just a simple way of doing your rebalancing without having to make an extra specific move to do it. I find it useful to not invest the dividend distributions. If you collect all your dividend distributions into a money market fund until they reach a significant amount, and then you can use those to make rebalancing purchases. If you reinvest them automatically, then you may have to sell some of the equities to do the rebalancing. But this is a way to avoid at least some of those sales. And obviously, many of the financial houses that are offering retirement plans include an automatic rebalancing, and that's obviously a lot less work to do. And it happens with it, even if you forget it, but you may give up some of these sneak paths for doing the rebalancing with the least tax effect. We're going to look now at the various asset classes. The two major ones would be fixed income and equities. Fixed income is usually thought of as cash and cash equivalents and bonds, the things that spin off interest. Equities are split into domestic equities and international stocks. And there are some alternative investments like REITs or commodities, which I'm not going to cover here, partly because they're beyond the scope of what we're talking about. Also, they're more complicated and more expensive than the standard funds for fixed income and equities, and they don't necessarily add a whole lot, if anything, to your portfolio. So I would focus on the fixed income and the equities first. There was a study done way back in 1986 by Gary Brinson and a couple of other gentlemen. It was updated later, but they looked at 82 of the major pension funds and decided that the bulk of the variance in the portfolio performance could be accounted for by your investment policy decisions. 91% of the variance was due to the decisions you made on your IPS. And those decisions including what asset classes to use and what are the weights. He said that less than 5% of it goes to actual specific security selection. In other words, picking the actual stocks contributed less to the variance of the performance, less than 5%. Market timing was even smaller, it was less than 2%. So the message here, frankly, is that even though most of us think of investing as spending most of our time on these two items, stock picking and market timing, it's really misdirected. We should be focusing mainly on getting the fundamentals right, and this goes back to your IPS. If you get your IPS right, the rest of it falls into place fairly easily. So I want to look here and show you very quickly what the different asset classes look like, at least the three major ones I'm going to look at here. I realize this is somewhat of an eye test, but what I'm showing here are the returns for 33 years, from 1987 to 2019, 1987, 1988, all the way through to 2019. And on the vertical scale, there's the return, the annual return starting 0, 2%, 4, 6, 8, 10% is this top line. And for cash, and this includes T-bills, probably money market kind of stuff like that as well. But for cash, back in the 80s and 90s, had a reasonable return, 4, 5, 6, 8%. One of these is over 8%. But then in the 2009, 10 through 16, it was negligible, real low. And then it's, the last couple of years has come back up again. But the key parameter to note here is that although you have high returns and low returns, there are no negative returns. It's always positive. It may go very low, but it's always positive. So you're not going to lose money, but you may not make a whole lot. The characteristics for cash, compound annual growth rate over this 33-year period was 3.2%, standard deviation 0.7%. Sharp ratio really doesn't apply because the Sharp ratio, if you remember, is the you take the projected return less the risk-free return and divide that by the standard deviation. But the cash, the equivalence really is the risk-free return. So I guess technically this is zero, but it doesn't make any sense to talk about a Sharp ratio for cash. Best year was over this 33-year period was 1989, when it had an 8.6% return. That seems a lifetime. Well, I guess it was a lifetime ago. A lot of us don't even remember an 8.6% return from cash. Worst year was 2014, and a lot of us do remember that, where it was barely over zero. Over the 33 years, there were no down years. Looking at the same kind of data for the bond market, this is the total bond market, which is a mix. It's an index that includes bonds of various types, corporate and government and so on, and various durations. But again, we've got the 33-year period along the axis at the bottom, and here we're looking at higher returns. This is 0, 5%, 10%, 15. The top line here is 20. And you'll note that some of these actually got above 15%. That's a pretty decent return from fixed income security. But the penalty you pay is that there's some negative years. There's one negative year here, 1994, negative year, negative here. And I think, although this is very small, I think this was actually negative as well. So it's a little more volatile than cash, but you do have higher returns, and that's what you'd expect. Characteristics here, the compound annual growth rate was almost 6%. You've got a higher risk. The standard deviation has gone from a fraction of a percent up to almost 4%. Sharp ratio 0.71. The best year was 1995 when you had a return of 18%. That's pretty decent. And the worst year was 2013, where it was negative 2.3%. Not too bad. I mean, it's negative, but it isn't a disaster considering that you got halfway decent upside to it. The number of down years, there were 4 of the 33 years were down for a 12% of the time of the years were down years. I'm going to look at the same data for the total U.S. stock market. Again, this is an index including a whole bunch of different stocks of various asset classes. Some of them may be growth, some of them may be value, and large cap, small cap, the worst. The total U.S. stock market. By the way, all of this data comes from portfoliovisualizer.com, which is a free website that is a great way of looking at all this kind of data along with the various other tools that are available, so I highly recommend it. The gentleman who built this portfolio, this website, his first name was Tyler. He doesn't like to give out his last name, but he did all of this for the love of what he was doing, and it's freely available to everybody, and there's no charge. He enjoys what he's doing, and he can afford to do it, so he gives back to the public that way. Okay, on this we've got the scale is greatly expanded. The zero lines along here, this is 10, 20, 30, 40% along this top line here, but it also goes negative, minus 10, 20, 30, 40 down here. So you can see, although you got some returns, many of them over 20 or 30%, you've also got some significant downside risk as well. One here that gets down to about negative 37%. So that was a real ouch year in 2008. So the characteristics here, if you summarize them over the 33-year period, is that the compound annual growth rate of just over 10%, the risk is way, way higher. The standard deviation of 15% is half as much again as the compound annual growth rate. Sharpe ratio of just over 0.5, not too bad. Best year was 1995, which was a return of almost 36%. And the worst year, 2008, was down 37% in that one calendar year. That was a time to buckle up your seatbelt and hang on. 7 of the 33 years were down years for 21%. 21% of the time was down. So the takeaway message here, I guess, is that the stocks have a higher return than bonds or cash, but they're more volatile as well. So there's a higher downside risk as well. So you have to be, if you want the higher return, you have to be prepared for the higher risk. So having shown you what those asset classes look like, what I want to do now is look real quickly at modern portfolio theory, and then we'll see if we can build up a couple of portfolios using this theory and what they might look like. Modern portfolio theory was put together by Harry Markowitz in 1952 initially, and Bill Sharpe and some other folks added to it over the years. But basically, what Markowitz showed was that you can build up a portfolio if you look at the correlation between the assets to maximize the expected return for a given level of risk, or the other way around, to minimize the risk for a given level of expected return. It's not just a case of going to a whole list of stocks and picking out the 10 or 20 best performers and tossing them into a portfolio and assuming that that's going to give you the best portfolio performance. It may not. It's important to look and see how the stocks are correlated with each other. We all know that risk and return, I hope we all know that risk and return are correlated. What I'm looking at here is the standard deviation along the bottom axis. This is the 10-year deviation, and the return on the vertical axis. This point here is for T-bills, which gives you, a low return and low risk. This is short-term, intermediate-term, and long-term bonds, which give you, a higher return but higher risk. Then out here you get the U.S. Large cap and small cap stocks in international and emerging markets. So even though it's not a perfect straight line, there's an obvious correlation here that shows that, if you want the higher returns, you're only going to get them by going with the more volatile, higher risk. I'm using risk, using standard deviation as a proxy for risk, because really what most folks mean by risk is the volatility, and that's what the standard deviation measures. So, we all should understand very clearly that the higher returns come with higher risk. Well, there is a third dimension besides risk and return, and that's correlation. So what I want to look at here is, if you have define a total return R, standard deviation S, and look at the correlation C, the correlation coefficient equal to +1 is perfect tracking where those two assets both zig and zag at the same time. When one goes up, the other goes up, and when one goes down, the other goes down, and they track each other perfectly. Correlation coefficient of -1 goes the other way around. When one zigs, the other one zags every time, and vice versa. And the correlation coefficient of 0 means that there's no tie-in at all between the two assets. It's just the movements are totally random. Knowing what one has done tells you absolutely nothing about what the other may or may not have done. So keep these in mind, and we'll put together the equation for that kind of wraps up what's happening under the modern portfolio theory conditions. I'm trying to define a portfolio P with two risky assets A and B, with returns R sub A and R sub B, standard deviation S sub A and B, and a correlation coefficient of C sub A, B, and weights W, A, and B. And the return from this asset is just going to be the weighted mean of the two returns. But the standard deviation is not just the weighted mean of the two standard deviations. It's a more complex equation. It's not quite as bad as it looks here. This is the equation, but when you dig into it, it actually makes a little more sense. It's really the root mean square of the standard deviations. Okay, so I want to look at what happens if we go back to the assets that we were looking at before, and before we get to that, we'll do a little theoretical analysis. I want to assume that we have two assets. The first one might be a bond fund with a return of 5%, a standard deviation of 4%. The second asset could be a stock fund with a return of 10%, a standard deviation of 15%. These numbers are just approximations for what we looked at earlier. And we want to build up a portfolio that varies from 100% of one and 0 of the other, all the way through to the other way around, in 10% increments. And then also vary the correlation from +1, perfect correlation, through 0 to perfect negative correlation, and see what the graphs look like. So we have the two assets. Let's just assume, first of all, that they're perfectly correlated. The correlation coefficient is 1.0. This is pretty much as you'd expect. It's a straight line. On one end, you've got your 100% bond fund here with the 5% return and 4% standard deviation. At this end here, you've got the 100% stocks with 10% return and 15% standard deviation. And in between are all the combinations for 100% stocks, 90% stocks, 10% bonds, and so on, all the way down to 100% bonds. No surprises in this. In fact, it's dull and boring. It's what you'd expect intuitively. And you get no extra bang for the buck by combining the two assets, other than that you get to pick where on the risk return line you're most comfortable. If you're not comfortable, if you want a high return but you're not comfortable with a 15% standard deviation, you might say, well, okay, 10% I can live with, so that'll give me maybe a 7.5% return. But again, there are no surprises in this chart. Now let's look at the same two assets, but assume that there's a correlation coefficient of 0.5. This looks very similar to the last one, except there's a slight bend here that you wonder, that's a little strange, but it doesn't do you any good. You still have to make the same trade-off, 100% bonds, stocks, or 90%, or where do you want to be on this curve? It gets more interesting when you go to 0 correlation, if you've got two totally uncorrelated assets. And this happens, I won't say all the time, but if you take a bond fund and a stock fund, in practice it could be close to this. Now the kink here has become more real, and this is beginning to show something intriguing. It means that if you had a 100% bond fund with 5% return and 4% standard deviation, you can actually do better than that by going with 90% bonds and 10% stock. Because if you go to this point here, you get 5.5% return for a slightly lower standard deviation. So not only do you get a higher return, you get a slightly lower risk. And that's what they mean when they talk about a free lunch. Some folks argue that this is the only free lunch in investing. Let's see what happens if you can find two assets that push deeper into the correlation to negative correlation. Here we're looking at a minus 0.5. Now this kink has become much more pronounced, and you'll see that if you go with 80% bonds and 20% stocks, you can get a 6% return. And in this case, you drop the standard deviation from 4% maybe down to close to 3%. So you get a good free lunch by going to here. There's no rational reason to ever invest in this. The 100% bonds for the parameters I've chosen for this is not a logical place to be, because you can get higher return and a lower risk by salting your portfolio with 10 to 20% stocks. I love this one. This is, as far as I know, totally hypothetical, perfect negative correlation. If you can find two assets that are negatively correlated perfectly like this, please let me know, and I'd be very interested. But if such assets did exist, you can actually get to zero risk, zero standard deviation. So if you go with 20% stocks salted into your bond fund, you get extra return, and the risk gets reduced all the way down to zero. I love that. So how well does modern portfolio theory work in practice? We're going to look at some simple portfolios first, comprising the total U.S. bond fund and the total U.S. stock fund that we looked at earlier. And we're going to build two portfolios. The first one is going to be 90% total U.S. bond fund and 10% stocks. In other words, a very conservative fund, but see if we can, in fact, get a higher return at a lower risk. And then we're also going to look at a more aggressive fund that's got 30% bonds and 70% stock. And we'd expect to get a higher return from this, but let's see how it works in practice. So the first portfolio one, the first one, we've got 90% bonds and 10% stock. It gives us, this is somewhat similar to the total bond market fund that we looked at a few minutes ago, but instead of having 4 negative years, as we did for the all bond fund, we've only got 2 down years. So that's a nice improvement right there. You got a down year here and a down year there, but the other 2 have disappeared because the 10% in stocks managed to pull those 2 down years positive. And you still got some pretty decent returns. The up years are actually a little higher in general because of the stock market contribution. Let's look at what happens to the portfolio too, the 30% bonds and 70% stock. This is obviously more volatile. This looks pretty similar to the 100% stock fund that we looked at the very beginning when we were just looking at the asset classes. And you have 1, 2, 3, 4, 5, 6. I think this is actually a down. Oh, I'm sorry, that's not. This is a down year. That's a slightly positive. You've still got 7 down years, but some of them are very, very low. They're only barely down. And this one that used to be minus 37% is now only minus 24%, I think it is. So in general, you've got most of the positive returns not quite as high as they would have been with the all stock portfolio, but the negative returns are tempered somewhat and easier to take. So if we look at the data on those 2 portfolios, well, let's look first at the bond portfolio that we had initially. This is 100% bonds, and this is the same data I showed you before, 6% compound annual growth rates, 3.8 standard deviation, and so on. Best year 18, just over 18%. Worst year, negative 2.7, 4 down years. And at the other end, we have the 100% stock fund with an over 10% return, 15% standard deviation. Best year, almost 36%. Worst year, 37%, and 7 down years. Now, if you look at the ultra safe portfolio, probably the safest portfolio that I've shown you today so far, 90% bonds and 10%. It's the old bond fund, except that you've replaced 10% of the bonds with 10% stock, just to salt it a little bit. brought the compound annual growth rate up from 5.9 to 6.4. Standard deviation looks the same. I think if you ran this out to a couple more significant digits, this is in fact slightly lower than this, but barely so. Sharpe ratio has gone up. Best year is slightly better. Worst year is better than the worst year of the all bond fund. And here's what we said before: you've only got 2 down years. So this portfolio one beats or exceeds this in all regards. There's no rational reason for ever owning this. This is a safer portfolio, and it's got a higher return. Now let's look at the more aggressive portfolio. With 70% stocks and 30% bonds, the compound annual growth rate has dropped from 10% down to 10 and change down to 9 and change, but the standard deviation has dropped by almost a third. So that's a big improvement there. The Sharpe ratio is better. The best year is worse than the 36% we had before. It's down to just over 30%, not too shabby. But the other big thing here, though, is that your 37% down is now only 24%. That's still a heavy hit, but that's what, this portfolio is obviously much more volatile than this and riskier, but you get a higher return. So that's as you'd expect. For the higher return going from portfolio 1 to portfolio 2, you pay a price in the volatility. But that's the essence of how portfolios get built together from different asset classes that are not correlated all that closely to control the risk, or to control where you want to be on the risk-return spectrum. Okay, so that was just with two asset classes. What happens if you want to diversify a little bit more? Well, different ways you can do it. Instead of taking just one single fixed income fund, the total bond fund, you might want to split it into short-term and intermediate or even long-term bonds. Replace the total stock fund with large cap or small cap, value or growth index funds, different corners of the Morningstar style boxes. If you wanted to, you could add in real estate or commodity funds. You could add in some internationals, either developed markets or emerging markets. It gets to be a fair amount of work when you diversify to, a large number of funds, and you don't necessarily pick up a whole lot more. There's sort of a diminishing returns effect as you go from diversifying from just 2 funds to 3 or 4 or 5 up to, I would never go beyond 8 or 10. 8 or 10, if you picked up most of these, will give you 8 or 10 funds, and it may give you a slight improvement, but you're doing a lot of work for something that's a little iffy. In my own personal case, in the past, I have had a number of accounts. My portfolio has included 7, 8, 9 funds, at some point in the past. But in the process of simplifying it now down to 3 to 5 funds, I think is adequate for me personally. That's where I put my trade-off. Partly because I want to simplify it, and partly because I want more time to do other things. But it's a subjective thing. You can pick where you want to be yourself. I wanted to show you a Callan chart. Some of you are probably familiar with this. It's basically a chart showing the performance of a whole bunch of different asset classes over the 20-year period from 2000 to 2019. This is an eye chart. I don't expect you to be able to read it, or you don't need to read it right now, but I just wanted to show you, for example, if you take large cap equities, that's this sort of darkish blue thing. Back in the early 2000s, they were down at the bottom of the chart, and they rose up to the middle. I spent a long time in the middle, hit close to the top in 2013, 14, very top in 15, dropped back to the middle again in later years, and now they're back up again. You can't predict when this is going to happen. They're kind of all over the map, and there's no telling, no way that I know of where you can be ahead of the curve and know in advance where it's going to be. If you want to see an extreme example of that, look at the orange ones. The orange ones are the emerging markets, which are more volatile. In the middle here, up at the top for a few great years, except that here you've got the top, the very bottom, the very top again. Spend some time, the top, down to the bottom, back up to the very top, very bottom, and then back to the middle. Literally all over the place. If you want to see this in more detail and be able to read the numbers and everything, giving you the website later on at the end where you can go to that website and pull up the original of this. I'm showing you here the correlation coefficients for the major asset classes. This again comes from Portfolio Visualizer. It's again a little bit of an eye chart, but if you go to the website, you can see all of this a little more easily. And also the correlation coefficients change with time. It depends. Are you looking at the last year, 2 years, 3 years, 5 years, 10 years? This happens to be for a 10-year period. So they change a little bit from, over time. I wouldn't worry about the details. What you're really looking at are the big picture, where are the real negative correlations. And even if they change a little bit, you just want to pull out the major patterns from it. But it's worth studying it a little bit so you can see for yourself which asset classes tend to track each other and which ones don't. So that's obviously key information when you're building your own portfolio. There are ways of getting into easing into building simple portfolios without necessarily doing all of the work. Vanguard has a whole bunch of index funds, cheap index funds. I love them for all the asset classes, and a number of different portfolio managers and financial advisors have offered on the web what their selection is for using these Vanguard funds. The reason I picked Vanguard isn't necessarily because Vanguard's a great company, although I think it is. It's just because all of these index funds are easily available over a long period of time, so the data is there on Vanguard to play games with it. But Rick Ferry, for example, offered one with just a 40% bond and 60% stocks. He made that a little more complicated. It went down. This looks like a typo on my part here because I think that should be 30%. It adds up to 110, which is not good. These are getting more complicated, and I don't know that you want to go this far. Well, let's look at Brinson here, for example. He said 40% in a single bond fund. What I'm showing here are 4 funds under the total U.S. stock. This is large cap value, large cap growth, small cap value, and small cap growth. And in the international, he's got developed markets and small cap, and I think it was emerging markets and so on, and added in REITs. That's 1, 2, 3, 4, 5, 6, 7, 8, 9 funds. That's right at the edge, I think, of what makes sense. And the same thing goes for some of these. But again, if you go on, you can Google lazy portfolios and get a whole bunch of these will come up. And it's interesting to look through them just to get a feel for how they're put together and what the performance has been. But in general, the performance from these simple ones is more than adequate for most people. And I personally am very comfortable with being in this simple end of the scale. If you want to keep it really simple, Vanguard offers a group of life strategy funds. There are actually 4 of them. There's their income fund, conservative growth, moderate growth, and they didn't call it aggressive growth, but this is the most aggressive of the 4 of them. The income fund has 80% fixed income and 20% stocks, split between U.S. and international. And the growth fund has the other way around, 20% fixed income and 80% in stocks. And these actually have a halfway decent performance. If you look at these guys down here, I think they've been around, to the best of my knowledge, for maybe 20, 25 years or something like that. And over that period, these more aggressive ones have averaged something in the region of, I think it's 8 or 9%, these are probably 6 or 7% at the conservative end of it because they're less volatile. The other thing you can do is look at target date funds, which are really single, one fund solutions. Almost all the financial houses now offer target date funds, mostly used in retirement accounts, 401ks and stuff like that. And the 2020 would be for folks who are immediately retired. But if you're younger, you may want to be looking at retiring in 2025, 2030, and so on. And as you go out here, they get more and more aggressive. These here will be weighted heavily towards fixed income. These will be weighted heavily towards the equity. These ones out here will have allocation close to that, whereas these ones here will be closer to the income fund. So that's another way of keeping it simple, and you get pretty decent returns. Rick Ferry put together, he published his 6 rules for disciplined investing. I just wanted to use that to summarize what we've been talking about for the last hour or so. Start off, have a long-term investment philosophy and form a prudent asset allocation based on that. That goes back to have an investment, a PIP, a personal investor profile, and an investment policy statement. That's really what he's talking about here. Select low-cost funds. I absolutely agree with that, because the biggest predictor of how funds are going to perform, in fact, turns out to be the expense ratio, the cost for the funds. The low-cost funds outperform the high-cost funds by about the expense ratio on average. Maintain that portfolio through all market conditions. Don't even think of changing it to track recent market activity, and do not hold back on new investments while waiting for the market to tell you what it's going to do. You're not going to figure out what the market's going to do. So don't wait. Don't keep stalling. Wait. Just do it. I'm giving you here a list of reading material that I think works pretty well. I'm not going to go through it all now, but if you want to download the slides and pick through this. One of my favorite books is A Random Walk Down Wall Street by Burton Malkiel. He wrote that, I don't know, probably 30 or 40 years ago. It's been updated numerous times, but it's a good read, nice simple read. Winning the Loser's Game is Charlie Ellis, which again is a light read. It's a little tougher going than this, but not much, and it makes a lot of sense. James Clunan, who founded the AAII, has a book out there called Investing at Level 3, which is probably worth reading. There's some concepts and strategies in there that are worth looking at. I'll give you a list of websites, including our national website, which includes a whole bunch of investing material along with financial planning and so on. Our local chapter website, Silicon Valley chapter, has most of our previous presentations are up there. A few speakers have asked us not to put up their slides, but for most of the presentations, the slides are up there going way, way back. Also, nowadays we have videos for a lot of them that are available. The Santa Clara County Library is probably the best deal going that it's really worth looking into. You can join the library for free, and once you get your library card, it gives you free access to Morningstar and to S&P and to Value Line and all of these. This could cost you hundreds of dollars if you sign up for it separately. You don't need to live in Santa Clara County to get a library card, but you do need to show up in person at one of the libraries to sign up for it. Portfolio Visualizer, I've already mentioned. That gives you a whole bunch of useful tools. Again, totally free. Cannon chart is available at this site. Bogleheads I like because of they've got it's all based on Jack Bogle, late Jack Bogle's philosophy. It's an interesting site. Mike Piper does The Oblivious Investor, which is always fun to read. And I've given you Rick Ferry's blog here as well. So that's about it. We have a mandatory cartoon here at the end which says, are you ready to start investing, or do you want to keep throwing your money away on food, clothing, and shelter? Thank you for joining me for the past hour, and I hope you got something useful from this, and we look forward to seeing you back in the future.